Hey guys, how you all doing? So Dan from Trading with Dan here. So today we're going to look at liquidity pools. Right, so what are liquidity pools? Liquidity pools are ranges in the price action where lots of orders are placed. So all sorts of orders can be placed in these areas. We can have orders to open long positions, orders to open short positions. We could have orders to close positions, so either to take a profit on a position or to take a stop loss on a position. So say you were already short, the market went up, and it would be the zone where you would buy to close your short position. Right, so what can happen if you're placing your stops in a liquidity pool? That is often an area that the market makers or bigger traders will try and push push the price action into that area, so they can trigger all those buy orders that are in that area. Either people buying to go long, either people buying to stop out of their short position, or also some people, there's orders in there for people to sell, but that's not really the orders they're looking at when they're trying to push the market up there, because what they're actually looking to do themselves in that liquidity pool is sell also. So you may get smarter traders that will put their counter trend orders in that trade, in that area. So say they wanted to sell, they'll put sell orders. So as you can see in this example here, the market sort of pushed up, we had an uptrend, it pushed up, and then we seemed to top out. So some traders would have shorted the market and shorted it on the way down, and they would potentially have their stops in this zone here. So that zone there would be a zone where they think, okay, if we get back above this high, then I will stop out my trade. So what that means is that is now a liquidity pool. What also is going to happen is that other traders are going to look at this area and be like, okay, so if we break above this level, I would actually want to buy because we're going to break out. So basically it is an area where we have a lot of orders. So what happens is the market then gets pushed back up to that area, we wick into that zone, but then we get rejected pretty swiftly. So that shows that basically more experienced traders identified this as a liquidity pool, and they actually put in counter trend orders, and then also to obviously sell once we pushed into that zone. And then also the bigger traders that actually pushed us, that market bought and pushed the price action into that zone to trigger those stop losses and that buying, they then sold into that as well to fill their orders, because big traders they don't want slippage when they start trying to sell the market when it's going down. They ideally want to sell the market, sell into people buying, because that means they get less slippage, and then also they don't have to pay market order fees, do they, that we spoke about in the order types video. So they will get filled in that liquidity pool. So that's kind of what happens, and you can see the market does start to come down again, and then again one last time it gets pushed up to that liquidity pool. Sorry, I had to keep on clicking off that. Pushed up to that liquidity pool, and this time finally we do have a sustained sell-off down, and this will obviously be after the big traders have filled all their positions that were trying to fill up. They then no longer have a need to push the market into that zone again, and then we can obviously have a big sell-off. So this will be a liquidity pool. So if you are placing your stops to buy in this zone, and then you're getting filled and the market then reverses and goes the other way, that's kind of how you can identify the fact you are placing them in a liquidity pool, and you are in fact the liquidity but that is getting used to buy. So you are buying here, whether you're going long or whether you're buying to close out your short, and then the market then turns around and comes back. Right, so trading liquidity pools. Obviously we went over this a little bit in the last slide. So now you know how to identify the liquidity pools like we did in that last example. You know where to place your orders in the right place to minimize the chances of you getting stopped out. So if we look here, you can see if you wanted to go short this market and you miss this opportunity, you just got to be patient. You may not get the price, but if you are patient, you place your short in that zone and then your stop above that zone. So you are clear of that liquidity pool. Also, if you did short early anyway, but you plan on running this trade all the way down, you can just place your stop. You can sell anywhere in here anyway, but just make sure your stop isn't in this sort of zone here. It's a bit higher up so it doesn't get triggered. So obviously if we do push through that liquidity pool, it's more likely the price is going up, and then you'd want to stop out the trade then. So that's basically how you would trade them. So how do you spot them? How do you spot these liquidity pools? Obviously in this example it's very easy to spot. You can see the wicks, you can see the horizontal. It's pretty obvious the liquidity pool in that example. But other ways, you can have extended consolidation ranges, rejection wicks on higher time frames. So you could actually zoom out to look at how the price action looks, the candles look on a higher time frame, so you're not sort of caught up with the daily, not the daily, but like the hourly and the 4-hourly price action in during that day. If you zoom out to look at where the actual levels are, where the daily candles are closing, where the daily rejection wicks are happening, you can obviously get a clearer picture. Also, especially in Bitcoin, because we do have a lot of leverage trading, you can look at zones away like 1% or 2% away from price action. So if someone's trading 100x, then their stop will be 1% away from price action. But if they're trading 50x, which obviously more people will do, then it will be a 2% move before they would get liquidated. So that move, that's 1 or 2%, becomes a potential liquidity pool. So say, we'll go back to the previous example. So say for example, people are selling here because it's looking like we're going to come down. They're selling there. What would happen is 1% and 2% above that price would become a liquidity pool, because the sellers that were selling here are going to have to close out their positions, or they're going to get automatically liquidated and closed, or they're going to just close manually with a market order beforehand around the 1% for the 100x traders, and then 2% for the 50x traders, and then that then pushes the market onwards and upwards. So it's a quick video that was on liquidity pools. It's not the most complicated subject. It's just areas where people have their stops, where people would be looking to actually play a breakout trade, and then also where people would be looking to short. So potentially the more experienced traders that then want to look to short, and then maybe have their stop where you should have your stop, out of the liquidity pool. Right, so anyway, thanks for listening guys, and I will catch you on the next video.